This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Well, I'd love to talk to you about something sensational. Instead, you'll have to settle for a brief discourse on peak inflation and the state of the economy and the stock market. That's what you get from a generally introverted philosophy major that's been studying capital markets for the last 20 years. Sure, there's plenty of sensational investment-related content on YouTube and TikTok, but the reality is, when it comes to investing, what works long-term is not sensational. Sensational is winning the lottery or getting lucky buying out-of-the-money options in a meme stock. Hopefully you'll find our commentary helpful, even if it's not sensational. For the most part, the economy is doing just fine. Yes, inflation is a problem. Supply chain issues due to the pandemic have been stubbornly persistent. And growth is slower than it's been, although the United States is doing better than most of the rest of the world. Unemployment is very low at 3.5%, and household income is positive. The consumer, the principal driver of the U.S. economy, is still spending. The last several weeks, we've seen a strong rally in stocks, particularly in the companies that have been hit hard this year. Since the recent low on June 16th, the S&P 500's gained 17%. We're still down more than 10% this year, but the recovery is welcome. And to keep things in perspective, although the losses this year have been alarming, despite being down 10%, the S&P 500 is up more than 15% annually for the last 3 years, and nearly 14% for the last 5. Equity returns have really been fantastic. The rally has been driven by second quarter corporate earnings results. For the most part, they've been better than feared. Shares of Walmart, Apple, Disney, they all moved higher despite a weaker June quarter. While the results have not been great, they were not such a disaster to justify the more than 23% sell-off of the broad S&P 500 through mid-July. As expected, company guidance for earnings in 2022 has been significantly reduced. Earlier this year, analyst estimates called for $225 in earnings for the combined companies in the S&P 500. The estimates have been reduced to $210. It's a reduction of nearly 7%. At $210, earnings growth this year is a meager 2.5% increase from last year's earnings of $205 per share. If inflation proves to be persistent, if it doesn't come down, the Federal Reserve will be forced to slow the economy further, increase rates more aggressively, reducing growth and hurting stock prices in the process. Right now, the revised 2023 earnings estimate is $240 per share, which is a slight reduction from the $250 per share estimate forecast earlier this year. This estimate seems optimistic. If $240 per share is likely, well, stocks are undervalued, although there's reason to be skeptical towards the 2023 estimate. It's just too early to tell. The good news is there is some reason to believe that inflation may have peaked. The price of oil is moderated. Housing prices are softening. Increases in the price of many foods have retreated or leveled off. The cost of shipping has declined more than 20% in the last several weeks. We aren't out of the woods yet. We'll have to see several months of positive inflation data before we can declare any kind of victory over inflation. But by historical standards, interest rates are still low. Here's a longer-term chart, the last 40 years of inflation in the U.S., and the interest yield on the 10-year Treasury bond. If inflation can trend towards the Federal Reserve's target of 2% over the next year or so, without having to raise interest rates too much higher, the strength of the U.S. consumer can keep growth from slowing too much. Economists and the market anticipate further interest rate increases this year, getting to approximately 3.75% for the Fed funds rate, up from 2.5% currently. This expectation is already priced into the stock market. If inflation backs off and further rate increases are unnecessary, the market's poised to move higher from here. Okay, so all this has been a bit more technical than I would like. It would be easier and maybe more palatable for our viewers to just come out and say something sensational with a headline in all caps that you need to buy or sell the market immediately. Neither is the case. Last month, we said in our update that valuations looked attractive after the sharp declines given the risks. Second quarter results were good enough, and inflation may have peaked. We remain cautiously optimistic that the recent rally can continue, that we'll end this year higher still, but risks remain. Watch inflation. As long as the consumer remains healthy, economic growth will continue, resulting in higher stock prices. We've increased our exposure to stocks over the last month. Now we'll wait and see how the economic data comes out. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.